Welcome to Talk Tickers. We're your essential deep dive, cutting through earnings call noise to bring you the clearest insights. Today, we're tackling Selective Insurance Group, ticker SIGI, and their Q2 2025 results. We'll explore the numbers, management strategy against some, pretty big industry headwinds and what it all means for you. Okay, let's get right to the headlines. Selective reported GAAP EPS of $1.36, and non-GAAP operating EPS came in at $1.31.
Right.
Which unfortunately missed the street's consensus. That was $1.55, so a decent miss there.
Yeah, about 0 and 24 sort.
But revenue, on the other hand, was pretty much in line. $1,326.7 million. That's actually up 11% year over year, which is, pretty solid.
Growth. But what really grabbed the market's attention, and maybe not in a good way, was the combined ratio. It landed at 100.2%.
Oof, over 100. Never what you want to see in insurance.
Exactly. It means basically an underwriting loss. Now, part of that, 6.7 points, was catastrophe losses. Expected, maybe, but still high. But the real story, I think, was the other piece, 3.8 points, or about $45 million, from unfavorable prior year casualty reserve development.
Okay. So they had to boost reserves for older claims.
Precisely. Claims from previous years turning out to be more expensive than they initially thought. And while, yes, net premiums written grew 5%, renewal pure price was up a healthy 9.9%, those negative factors, especially the reserve charge, really hit the headlines hard.
Got it.
On the flip side, though, their after-tax net investment income looked really good, $101 million.
Okay.
That's up 18% year over year. And if you strip out the cats in that prior year development, the underlying combined ratio actually improved. It came in at 89.7%.
So a real mix of signals then. Strong underlying performance fighting against these headwinds.
That's the paradox, yeah. The market just zeroed in on the misses, the immediate pain points.
Okay, let's unpack that reserve development then, because that brings us right to this term we keep hearing, social inflation. What exactly is it, and how did management tie that $45 million charge to it?
Right. Social inflation is the core issue here. It's basically the rising cost of insurance claims beyond just normal economic inflation. Think bigger lawsuits, larger jury awards, maybe changing ideas about corporate responsibility, things like that.
Yep.
And management was very direct. They linked that $45 million directly to what they call continued casualty severity, which is their term for this social inflation trend. They're saying it's broad, industry-wide, affecting bodily injury claims across the board, not just something specific to Selective's book of business.
So not a Selective problem per se, but an industry problem they're dealing with.
That's their argument, yes. The reserve strengthening mainly hit general liability for $20 million that was tied to the 2022 and 2023 accident years, particularly in umbrella and product lines. And then commercial auto got hit for $25 million related to accident years 2022 through 2024.
So really recent accident years then. That's interesting. It's not like digging up ancient history.
Exactly. That's a key point management made. They're reacting early, even to these immature accident years. It's driven, they say, by higher paid severity. The actual cost of claims being paid out now is higher than expected for these recent incidents. It's not necessarily more claims, but bigger ones.
Got it. Severity, not frequency, for recent years. Okay, so facing this industry challenge, what's Selective's game plan? How are they trying to combat this?
They laid out a pretty clear three-pronged approach. First is pricing. They're pushing for renewal price increases higher than their expected loss trends. We saw general liability up almost 12%, commercial auto over 10%. Pretty strong numbers.
Aggressive pricing. Makes sense. What else?
Second is underwriting. They're tightening guidelines on specific liability risks, managing their exposure, especially in tougher legal jurisdictions. Things like cutting back on new umbrella policies over $5 million, raising minimum premiums, and just generally trimming risks they see as underperforming.
So getting pickier about the business they write.
Exactly. And diversifying, too. Expanding into excess and surplus lines, E&S, which handles tougher risks, and also building out a strategy for mass affluent customers in personal lines.
Okay, pricing, underwriting. What's the third part?
A third is claims handling. This is crucial for managing that severity issue. They're specializing their claims adjusters by claim type and location, reviewing cases heading to trial more intensely, even using jury consultants and mock trials.
Wow, really getting granular there.
Yeah, and developing models to spot early which claimants might lawyer up. It's all about proactive management in this environment.
Right. Sounds comprehensive. But are these strategies actually working? How do the different business segments look? Is the pressure felt everywhere?
Good question. And no, it's definitely not uniform. There's a real divergence. Personal lines, for instance, actually had a strong quarter. Combined ratio of 91.6%.
Wow, that's a huge improvement year over year.
Massive, like 26.5 points better, driven by those huge rate increases, 19% on renewals. And they kept retention at 79%, even with those hikes. Now, net premiums written did drop 5% there, but that's part of the plan, shifting towards profitability and that mass affluent target.
Okay, so personal lines is looking better due to deliberate action. What about the others?
Excess and surplus E&S lines also look good, still performing strongly. Combined ratio under 90 at 89.8%. Net premiums written grew 9%, helped by a 9.3% price increase. Management seems pretty bullish on growth opportunities there.
Makes sense. E&S often thrives when standard markets tighten. And commercial.
Commercial lines. That's where the pressure is most evident. Combined ratio was 102.8%.
Okay, still over 100.
Yeah, and that includes nearly 5 points of that unfavorable prior year development we talked about. They did get an 8.9% renewal price increase, but retention actually dropped a couple of points to 83%.
So customers are maybe balking a bit at the higher rates, or competition is stepping in?
Probably a mix of both. Rate increases, underwriting actions, and increased competition were all mentioned. It shows the impact of their assertive stance.
Okay, so putting it all together, the reserve hits, the strategies, the segment performance, how did this translate into their guidance for the full year? That's always a big one for the market.
It definitely impacted guidance. They raised their expected GAAP combined ratio for the full year 2025, moved it up to a range of 97% and 98%. That's up from 96% to 97% previously.
So baking in the Q2 pain and expecting more severity pressure?
Explicitly, yes. They said the adjustment reflects the Q2 prior year development and the expectation that casualty severity will remain stubborn. But, and this is a key assumption, the new guidance assumes no additional prior year casualty reserve development beyond what they just booked in Q2.
Okay, that's a crucial caveat for investors to watch.
Absolutely. On the brighter side, though, they lifted their guidance for after-tax net investment income, raised it to $415 million from $405 million. That reflects how well their investments are doing.
Right, so the message seems to be, underwriting is tough right now, but our investment engine is strong and will help carry us through.
That's exactly the narrative. Earn through investment income while underwriting normalizes. It buys them time while the pricing and underwriting actions hopefully work their way through.
And speaking of that investment portfolio, how are they positioned there? And how's the overall capital situation holding up?
The investment portfolio looks pretty solid and conservative. About 92% is in fixed income and short-term stuff. High credit quality, A+, average duration around 4.2 years. And the new money they're putting to work is yielding about 5.7% pre-tax. So that feeds into the strong NII outlook.
Okay, sounds stable.
Capital-wise, they seem comfortable too. Ended Q2 with $3.4 billion in GAAP equity. Book value per share was up 9% in the first half. Their debt-to-capital ratio is 21.1%, which is well below their internal ceiling of 25%.
Any share buybacks, dividends?
They declared the regular quarterly dividend, 38 cents, payable in September. No share repurchases in Q2, but they still have about $56 million authorized if they choose to use it later. And importantly, they successfully renewed their reinsurance programs, giving them protection against large casualty and property losses. Prudent risk management there.
Okay. So let's pivot to the investor perspective. You mentioned the market reaction wasn't great. Tell us more about that.
Yeah, it was pretty stark. The day in the earnings release, the stock opened way down, around $75. That was a drop of about 17% from the previous close, near $90. And it closed right around that $75 mark.
Ouch. And volume.
Huge volume spike. Over 3 million shares traded, way above the usual 500,000 or so. It clearly signaled significant investor caution. The focus was squarely on the EPS miss and that higher combined ratio guidance. It sort of overshadowed the good news on investment income and the underlying improvements, created a bit of a near-term, credibility gap, maybe.
Yeah, the market wanted proof the reserving issues were contained, perhaps. Did the analysts on the call push back on management's "it's an industry problem" narrative? Did they uncover anything unique to Selective?
They definitely probed that, but management stuck to their guns, reiterating the social inflation issue is broad, not specific to their book. They confirmed they're comfortable with their current loss picks for commercial auto, assuming an 8% trend versus the 10% pricing they're getting. They feel they're outpacing the trend.
Okay.
Analysts asked about workers' comp too. Selective mentioned a kind of unique flattening frequency trend there, maybe due to their construction focus, which is different from others. Management did acknowledge that reacting to severity in these very recent immature accident years for long-tail lines is, well, kind of unprecedented. It's tough for everyone.
So still mostly an industry story, but with some specific portfolio nuances.
Yeah, that seems fair. They also confirmed things like their umbrella book being supported by underlying policies, mostly lower limits, giving them better insight. So unique elements, but the core challenge feels industry-wide.
Unprecedented times indeed. Okay, looking ahead then, what are the key things, the catalysts, that you think investors should really be watching?
Well, first off, we're heading into the peak U.S. catastrophe season in Q3. That could obviously swing property losses significantly.
Always a big variable for insurers.
Definitely. Beyond that, keep a close eye on further rate filings and those retention numbers, especially in commercial and personal lines. Are they sticking? Is competition intensifying? And of course, the next earnings update, probably late October, that'll be critical.
What's specifically in that update?
Any signs of further casualty reserve development would be a big negative, given the current guidance assumes none. Persistent high severity trends would also be watched closely. What could really help reset sentiment is a decisive beat on that underlying combined ratio, showing the core business is improving, coupled with continued strength in net investment income.
Got it. Prove the strategy is working and the investment buffer is holding. All right, perfect time to transition to our This Is Not Financial Advice segment. Based on everything we've discussed, what's an outrageous but plausible trade idea you've cooked up?
Okay, here's a thought. Playing on that earn through investment income while underwriting normalizes theme. Given management's conviction that the reserve hits are for recent immature years and driven by an industry trend, how about a long-dated out-of-the-money call option play on SIGI?
Interesting. Long-dated calls.
Yeah, maybe looking out to mid to late 2026. Strike price perhaps at or even above where the stock was before this earnings drop.
Okay, that's definitely leaning into the outrageous part, betting on a recovery when sentiment is low. What makes it plausible?
The plausibility comes from a few things. One, that strong, reliable investment income stream acting as a buffer. Two, the aggressive pricing and underwriting actions they're taking now need time to fully earn through the results. And three, management does have a history of reacting relatively quickly to loss trends. This strategy gives you time. Time for those actions to mature, time for maybe some clarity or even an inflection point on social inflation trends. If the market starts believing the earn-through story and the underlying results confirm it, you could see a significant re-rating.
So about that time, investment income and management actions heal these wounds, potentially leading to a snapback in the stock price down the road.
That's the idea. High risk, potential for high reward if things break their way over the next year or two. Definitely not advice, just a thought experiment.
Absolutely. And that brings our Talk Tickers deep dive on Selective Insurance Group's Q2 2025 earnings to a close. What we've seen is, a company definitely facing the industry headwinds of social inflation head on. They're using strategic pricing, tighter underwriting, and relying on that strong investment portfolio, even as the market seems a bit skeptical right now.
Yeah, it really underscores why you have to look past just the headline numbers sometimes.
Yeah.
Understand the strategy, the moving parts, especially that dynamic between underwriting challenges and investment strength.
As always, remember, this is purely for educational purposes. It's not financial advice. Please do your own homework and due diligence. So what stood out to you in Selective's quarter? Do you buy the earn through narrative? Let us know your thoughts.